Hey everyone, and welcome. Today, we're going to tackle a huge part of your salary that isn't always about the cash you see in your bank account: perquisites. We'll be breaking down Section 17 of the new Income Tax Act 2025 to get a crystal clear picture of how these benefits are identified, valued, and, of course, taxed. So, let's start with something you might have wondered about. Picture this. Your company sets you up with a house and maybe even a car. Are these just generous, tax-free bonuses? Or does the government actually see them as part of your taxable income? That's the big question we're diving into today. Okay, let's get right into it. The entire playbook for perquisites, or perks as they're often called, is laid out in Section 17 of the Income Tax Act 2025. This section is the bedrock for everything we're going to discuss. So for employees and employers alike, getting this right is absolutely non-negotiable. So what exactly is a perquisite? Well, the easiest way to think about it is as a benefit you receive in kind, not in cold, hard cash. It might not be money landing in your account, but it's still a super valuable part of your compensation. And the law recognizes that value, puts a number on it, and treats that number as taxable salary. Now, Section 17.1 doesn't just give us a vague definition, it gets very, very specific about what counts. So let's unpack the main categories it lays out for us. First up is probably one of the most common and often most valuable perquisites out there: employer-provided accommodation. The tax impact here can be pretty significant, so it's a critical one to understand. The law looks at this in two main ways. First, you've got rent-free accommodation. Pretty straightforward, right? Your employer gives you a place to live completely free of charge. The calculated value of that benefit is taxable. Second, there's concessional rate accommodation. Here, you might be paying some rent, but it's less than the market rate. In that case, the discount you're getting, that difference, is the taxable perquisite. Next up, we have a much broader category that's kind of a catch-all for various other benefits and amenities. But, and this is really important, it only applies to certain types of employees. Yeah, Section 17.11c is very specific about who this targets. It's not for every single employee. The rules are aimed at company directors, employees with a significant ownership stake in the company, and anyone earning above a certain salary level. You can see the idea here, right? It's to make sure that major non-cash benefits for key personnel are properly taxed. Now for our third major category, and this one is incredibly relevant in today's corporate world, especially in the tech and startup space. We're talking about securities and shares. Ever wonder how things like employee stock options are taxed? Well, Section 17.11d gives us the answer. If your employer, or even a former one, gives you shares for free or at a discount, that benefit is a taxable perquisite. This covers things like ESOPs and sweat equity. The taxable amount is the difference between the fair market value of those shares when you get them and whatever price you actually paid. So, we know what perquisites are, but how do we actually put a number on them for tax purposes? This is where valuation comes in, and Section 17.4 gives us the all-important rules and definitions we need. The key to all of this is the idea of fair market value, or FMV. Section 17.4a makes it clear that the tax authorities will prescribe the exact methods for figuring this out. For any tax professional, knowing these rules inside and out is absolutely crucial because this number directly determines the tax liability. And what exactly do they mean by a specified security? Well, Section 17.44f clears that up. It points to the main definition in the Securities Contracts Act, but importantly, it also explicitly states that this includes securities offered under an ESOP, so there's no room for doubt there. So, while the general rule is that perks are taxable, the law does carve out some really important exceptions. One of the most significant ones deals with expenses for medical treatment abroad for an employee or their family. But this exemption isn't a free pass. There are some very strict conditions. For the costs of treatment and accommodation, the exemption is limited to the amount that's permitted by the Reserve Bank of India. And for travel costs, the exemption only kicks in if the employee's total income is below a certain limit. This is clearly designed to help those who really need it most. All right, enough theory. Let's make this real. How does this all work with actual numbers? We'll use our rent-free accommodation example to see exactly how the valuation is done. Okay, so here's our scenario. An employee is living in a company-owned flat. We'll just use some simple round numbers to walk through how the calculation works based on the official rules. Let's break it down. If the employee's annual salary is, say, 20 lakhs, the rules might value the perquisite at 15% of that salary. That comes out to 3 lakhs. Since the employee pays 0 rent, that full 3 lakhs is considered the taxable value of this perk, and it gets added to their total income for tax purposes.
So you know the law, but are you compliant? For employers and tax professionals, getting the compliance right is absolutely everything. One wrong move can lead to interest and penalties down the line.
Here's a quick checklist for employers. 1. You have to correctly identify and value all perquisites based on the rules. 2. You have to report that value accurately on the Employees Form 16 and in your TDS returns. And 3. You have to make sure you're deducting tax at source on the total salary, which has to include the value of these perquisites.
So what are the common mistakes to watch out for? A big one is just forgetting about the smaller benefits. They can add up. Using outdated valuation rules is another frequent error. You gotta stay current. Bad documentation is a huge red flag in an audit. And finally, don't forget that perks provided even to former employees can still be taxable.
Wow, we've covered a lot of ground, from what a perquisite is to how it's valued and what you need to do to stay compliant. Let's just quickly summarize the key takeaways from our deep dive into Section 17.
Here it is in a nutshell. 1. Perquisites are taxable, period. 2. The big ones you'll see are accommodation, amenities, and things like ESOPs. 3. Valuation isn't a guess. You have to follow the prescribed rules. 4. For employers, proper reporting and TDS are non-negotiable. And 5. Yes, there are some exemptions, but they come with very strict conditions.
And that's our look at the essentials of perquisites. I really hope this explainer was helpful. If it was, please do take a moment to like, subscribe, and share it with others who might find it useful.
And just a quick reminder, this is for educational purposes only. Tax laws are always changing, so please be sure to consult a qualified professional for advice that's specific to your own situation.